Understanding Investments a Few Minutes at a Time by Daniel Dower. From Chapter 9, Fundamental Analysis, Issue Number 36. Margin. Gross margin is a firm's revenue less cost of goods sold, then divided by revenue, where cost of goods sold includes variable and fixed cost directly linked to the sale, such as materials, labor, and manufacturing, not operational costs such as administrative and marketing. Gross margin represents the profit from selling an extra unit if no additional operating costs are incurred in doing so. A low gross margin indicates that the majority of the firm's revenue are consumed in the production of goods sold, as opposed to marketing or overhead. Therefore, such firms are likely to be more sensitive to input costs. Since factories and other fixed manufacturing costs are part of cost of goods sold, gross margins may be significantly impacted by factory underutilization. Operating margin, also referred to as operating profit margin or return on sales, is a firm's operating income divided by revenue, where operating income is revenue less cost of goods sold less operating expenses. Operating margin represents the profit before taxes, interest, and dividends. A firm with a low operating margin may have significant input costs, if the gross margin is low as well, or may have significant marketing, sales, and distribution costs. For example, grocery retailers often have very low operating margins. Profit margin, also referred to as net margin or net profit margin, is a firm's net income divided by revenue, where net income is revenue less all expenses. In addition to the factors above, profit margin may be impacted by interest expense, taxes, or other special charges. Companies with a competitive advantage often command pricing power over their products and are able to maintain higher prices and higher margins. Over time, a firm's competitive advantage may erode as the products are duplicated by competitors and pricing power wanes. In the long run, absent significant brand value, strategic land, or some other economic moat, most products will become commoditized, at a point at which profit margins are near zero in a fully saturated market.